Hey friends, I wanted to talk to you about something going on in the stock market right now, and you probably know what it is, but first I wanted to be explicitly clear. Nothing in this video or any other content of mine is investment advice. This is for education purposes only, and this particular video is a case study to try to illustrate kind of how some things might work. So please do your own research. Do not take actions off of the video. Do not jump into things sharply or do anything crazy. Let's not lose our minds. Just enjoy the video and maybe get a little bit of learning and a little bit of fun. All right, so that being said, you probably guessed it. It's GameStop. GameStop's back. Roaring Kitty, deep effing value, Keith Gill, the man, the legend behind GameStop, a couple days ago resurfaced on Twitter with a single meme, a picture of a man leaning back in his chair and then all of a sudden, suddenly jumping up. And what happened? Well, about what you might be able to expect would happen with GameStop. It was up 70% within like the first hour of trading, of course. It was up pre-market. That's all it was. It was just a meme. Now, since then, he's created more memes and people are trying to read into him, trying to figure stuff out. Who knows what's going to happen? So first 2 days this week, GameStop was surging. It's kind of deflating now. We'll see what happens. A lot of people kind of recognize that this isn't quite right. It's like if you look at GameStop's annual report, if you look at their earnings, if you look at their earnings history, if you look at their revenue trends, their profit margin trends, like all of the KPIs, all that stuff, it's like it doesn't warrant this level of stock movement, like sudden doubles and then halves and like jumping all over the place. Like it doesn't make sense. And so a lot of people kind of intuitively know that there's a market mistake going on here. So it's like, well, how can you exploit it? So I've seen a lot of people like, all right, let's YOLO, let's buy some stock, and they'll write it up and try to sell it and try to make a profit. It's like, unless you're a day trader, and even if you are a day trader, I don't know many people that have been successful with a strategy like that. Most people get their face ripped off. Usually what happens is like, okay, maybe like the first time you do it, you make a swing and you make some money, and it's like then you start feeling good about yourself, and then you make a bigger swing, and then you lose all your money. Or better case scenario, you make a swing and you lose a little bit of money, and then you're like, oh man, I touched the stove, it's hot, and you walk away. And you're smart for doing that. So it's like, and then some people, of course, like we're like, oh, well, it's way overvalued, I want to short the stock. Completely ignoring that a key part of shorting strategy, which I also don't recommend at all, is momentum. It's like it doesn't matter if something is overvalued. If it's got momentum going up, the null hypothesis is it's going to keep going up. And so it's like, so what if it's overvalued by 2 or 3 times? If you short it and it goes up another 2 or 3 times, it's like you're broke. You've probably lost more money than you put up. That's the unfortunate thing about shorting is your losses are unlimited. And you could really get taken out of the game quick. And it's just because of a timing issue there. It's like your hypothesis, your thesis may be actually correct. Maybe the stock goes to zero eventually. But it's like you're on a time game now, not just a value game. And so live by the sword, die by the sword. I would stay away from that stuff. That's like playing with fire. It's like Joel Greenblatt would always say, you can run through a dynamite factory with a lit match. It's like you may live. It doesn't mean you weren't stupid. So take from that what you will. So how could you potentially play a scenario like this, where it's like, intuitively there's something going on, there's a market mistake. And so it's like, okay, well, what could I do to potentially put the odds in my favor? And this is where you got to use some first principles thinking and maybe do some unique things. And so like, there's more than one way to take a position in GameStop. You don't have to just buy the stock or sell the stock. It's like you can use options, derivatives. You can look at the bonds. You can look at anything related to it, all these other metrics and things like that. Hell, if you were like internal to the company, you could look at issuing stock. They could use that to your advantage. If you were a supplier, you could use that to your advantage to renegotiate terms. If you were a buyer, like a distributor, you could use that to your advantage to renegotiate terms. There's a million different ways that you can do this. The one thing available to retail and do-it-yourself investors is options. If you have options in your account and can trade options, you can buy and sell put options and buy and sell call options. And the unique thing about options is that an options price is made up of many variables, not just a derivative of the stock price. You've also got interest rates that go into it, time, and volatility. And that, my friends, is the key. So if you look at the volatility of earnings for GameStop, the volatility of revenue for GameStop, and then compare those fluctuations to the volatility of the stock price or the volatility of the market as a whole. You can even look at the historical beta of GameStop and look at what kind of volatility might be expected. And you'll see that some of these options that are trading at like 100, 200, 300 more percent implied volatility, like ludicrous volatility. And so it could be a bet. I'm not saying that this is true, and I'm not going to say it's a safe bet, but it could potentially be a bet if you think that GameStop volatility is unwarranted because of a meme. I mean, come on, it's a meme. Then perhaps it's the volatility that's overvalued. Now, how much you play that? It's like you can use these options if you sell, say, for example, deep out of the money calls. Well, again, you might get your face ripped off because it very well could hit those strike prices and there's unlimited losses. But if you sell, say, deep out of the money puts, you're basically selling the volatility on this. And what you might see, which we saw in 2021, was some of these deep out of the money options actually lost value as the stock price came down. You would think intuitively that as the stock price gets closer and closer to the money, the options become more and more valuable. But the volatility was the dominant component in those deep out of the money options. And so as the stock price came down and deflated, volatility collapsed. And that was the dominant effect. And so the option price, instead of going up, actually went down. And so how might you take a look at this? It's like, well, you can look at GameStop. They don't have any debt. If you look at their annual report, and again, do your own research because I very well could be wrong. So let's just say, for the sake of argument, they don't have any debt or very little debt. They've got some cash. And so you say, okay, well, how much cash per share do they have? So like by my count, probably about $4 per share. So let's say that you were to sell a $3 put option expiring, say, in a year. It's like, well, what are the odds that GameStop is going to go bankrupt or perform so horribly that the stock price will be trading between $3 a year from now? It's like, well, it absolutely could happen. You could very well lose on this. But it's probably going to have to lose a significant amount in value. Like even before the stock started getting bid up, it would still have to lose like 70% of the pre-bid up value, or even more than that, maybe 80% or 90%. And from now, at one point it was like, okay, we'll have to lose 95%. Now it can do that. Don't let that act as your margin of safety. Ultimately, it's probably the cash and the ability to stay in business that's the margin of safety there. And so even if GameStop eventually does go broke, even if it eventually does go bankrupt, if it eventually does, get phased out because, the world moves on, it's like you could use time and volatility and financial engineering in your favor here to potentially harvest a market mistake. Now, there's no guarantees. That stock could be $2 a share and you could get put with those shares and you could lose money. So you're adults, do your own research, take a look at it. But I just encourage you, it's when something seems not quite right, don't just jump in and buy the stock or short the stock. Look for the actual way to play it. Unpack the components, do the work, and think about it. And sometimes that requires a lot of thinking. Sometimes we actually have to dig in, and it might have to take several walks and kind of piece things together. And it's like maybe you'll get one piece of it one day, and then maybe you'll get another piece of it another day. And so, but keep that in mind for maybe the next time something like this happens. And then another interesting kind of theory you could think about is like, okay, well, what if this thing dies down again like it did last time? And now it's like volatility gets back to normal or even low. It's like, usually if you buy deep out of the money call options, it's potentially a waste of money. You're kind of lighting money on fire. But with GameStop, you never know. And so, if you had, my guess is, I haven't done the math, but my guess is if you had been buying deep out of the money call options ever since the stock calmed down, starting in 2022, up to the present, you would have lost money every month until this month. And you probably would have made 100, 200 times your money, who knows what, and it very well could have made up for all of those losses. Maybe not, depends on how you kind of engineered it there. So a couple things to think about. In the future, whenever you see things like this, I encourage you to look in and try to find these key nuggets, these takeaways, these lessons, and not just think in 2 dimensions, but think in multiple dimensions. All right, friends, until next time, I hope you have a blessed day, a great weekend this weekend, and I'll talk to you soon. Take care. Bye-bye.